recording has started. So recording has started, okay. So we will get underway. It's 10:30, our allotted time to commence. So good morning, everyone. Welcome to the latest of our Worrells webinar. My name's Michael Griffin. I am one of your Brisbane partners here in sunny Queensland. Joining us today, we have partners and staff from across all of our Worrells offices. In particular, we have Graeme Beattie, partner from New South Wales, and Cam Bond from Victoria, Senior Manager in the Victoria office. Graeme is going to be presenting to us today on the topic, do my clients qualify for a small business restructuring process? So before we commence proceedings and hand over to Graeme, just a couple of operational issues to deal with. If anyone does encounter any technical issues and for some reason isn't able to stay connected or reconnect, then we are making a recording of today's webinar, and that's going to be available at the conclusion of today's webinar session. Feel free to distribute that to your colleagues or anyone else that you think may have an interest in today's webinar. I'm sure you will find it interesting. If there are any questions, as Ken said earlier on, if there are any questions, feel free to chat, use the chat function to type those in. Kent will either interject Graeme during the course of the presentation if he thinks it's something relevant to where he's at the moment, or deal with that at the end, time permitting. If there are more questions than we can deal with in the allotted time, don't be concerned. A Worrells person will come back to you either by phone or email, and we'll address that then. We'll also be distributing CBD certificates to all of those who are attending the webinar today, so that you can use that for your various professional development requirements. Now, Graeme, as I said before, is a partner. He's actually the managing partner for New South Wales and ACT in Worrells. Graeme has over 20 years of experience in corporate insolvency from businesses of all sizes across a vast area of expertise and various big business models and structures he's been involved in, including deeds of company arrangement, members of voluntary liquidations, credits liquidations, receiverships, trade-ons, and alternative funding options. Graeme's industry experience includes retail and wholesale, manufacturing, transport, agriculture, IT, property development, and professional services to registered clubs. There's not much that he hasn't done. He's a member of CPA and our ARITA organisation, well-rounded qualifications and a wealth of experience that makes him more than qualified to deal with today's topic. So, Graeme, over to you.
Lovely. Thank you, Michael. Appreciate the introduction and good morning to everyone. I think now I need to go into sharing of my screen. Okay. So everyone should be able to see the slides here. We'll get straight into the topic for today, which is, do my clients qualify for a small business restructuring process? So first item I need to cover off is our usual disclaimer. Just read that for you so that you're all across it. It's all material contained in this presentation is written and discussed by way of general comment. No material should be accepted as authoritative advice, and anyone wishing to act upon material contained in these slides or discussed in the presentation should first contact Worrells for properly considered professional advice, which takes into account specific situations. As you would all know, we've got partners and staff around the country that are available to answer your questions and sit down and have complimentary consultation to talk about client-specific issues. So the agenda for today's webinar, we will be covering off or looking at the small business restructuring process and some quick framing around a definition and what it is. We'll look at the role of the small business restructuring practitioner. We'll look at the role of the director in that type of an appointment and process. And then we'll get into the eligibility criteria so we can look and see if it will actually fit with any of your clients. And then I'll make some comments and observations around the impact on the insolvency landscape. So just before I move forward, just a quick background on where this came from. The provisions came in the beginning of January, 1 January, and the process went live from there. Prior to that, there had been a whole series of consultation, which was done very quickly between the industry, the professionals, and government. It was one of the quicker processes that has ever occurred, but it has led to what they call a debtor in possession model. Now, what you will find is a lot of firms like ours have had to get prepared for this very quickly. So it has been a process that is not very well understood at this stage, and we haven't seen a lot of clients take it up at this point in time. All right, so let's move forward. We're going to first look at the small business restructuring process. Just bear with me a moment. Okay, so the actual process itself is a debtor in possession model. What that is the control of the company remains with the director. So this is different from our former voluntary administration process, which is still an option that is available, but the control of the entity is not with the practitioner. The control of that entity stays with the actual director. If I take a quote from the ASIC website in relation to this, ASIC have said that the restructuring process allows eligible companies to retain control of the business, property, and affairs of the company while it develops a plan to restructure the company's affairs with the assistance of a restructuring practitioner. So the process itself allows the director to retain control of the entity and its assets, to retain control of ordinary business type transactions, whilst that director works with a restructuring practitioner like ourselves to develop a plan with the business owner and in order to restructure the company's creditors. Once that plan is developed, there will be a subsequent then vote on that restructuring plan to see if it is accepted by creditors. Now, some of the other points to note in relation to that process is whilst the company remains in the possession of the director, the creditors, the trading creditors and the like, still need to be aware that that process is occurring. So during that process, the company needs to have on its title documents and the like, the tag restructuring practitioner appointed. So much to, I suppose, what was originally a belief that this was a process that may not have been totally transparent, or that the outside world may not have been aware that this was going on, there is a requirement on public documents for that tag to be there. And so you will find during the process that trade creditors and the like will become aware fairly quickly that the process is occurring. The process also requires, as we've put in here, a small business restructuring practitioner. Now, small business restructuring practitioner is limited to conducting simplified liquidation and restructuring processes. We're still expecting further clarity around this side of things, but at this stage, originally we understood that this would be a limited form of liquidator type license or a qualification that ASIC would register. As of reading yesterday, ASIC's requirements on their website publication was that a small business restructuring practitioner was required to be a registered liquidator. So we expect that that may change slightly in the future for a small caveat, but that doesn't appear to have occurred at this stage. What was the purpose of the process, I suppose, is another question that would be asked and that we pondered as well. This and a simplified liquidation, which is another form of the simplified regime that came in, was introduced by the government and Treasury in order to allow for better and more simplified, more cost-effective, I think they've said to ability to address some of this wave of insolvencies that has been predicted to come through. There was concern as to whether there were enough actual liquidators in the country to deal with the workload that was required. At this stage, we haven't seen the effect or impact of that, but just a little bit of framing around the background as to why that might have occurred. So let's just dive into a little bit of commentary around the small business restructuring practitioner. And I go through comments around some of this and the director and the like, so that we can really start then looking at your clients and do they qualify for the process. So the small business restructuring practitioner is somebody like myself or Michael that is a registered liquidator. Our role in the process is to provide advice on the restructuring. It is to assist in preparation of the plan. Clearly, we've got a situation here where we will be dealing with directors that don't have prior experience in putting such a plan together. Now, we'll talk in later slides around the director's obligation to prepare the plan and prepare the proposal statement and the like, but clearly it's not something that you're going to have directors that are highly experienced in this type of thing. So it's our role to assist them and guide them in the preparation of that plan. We will need to make a declaration to creditors. We'll need to be commenting on the eligibility of the company to meet and discharge its obligations, or the likelihood of that. We'll be required to set all the information that's needed out in a proposal statement. And then we'll also be needing to identify things like related party creditors and deal with the grounds of whether the grounds of eligibility are met or not met, and whether the requirements are able to be discharged. So one of the conversations that I've had with my staff during this process is what requirements we would have to investigate. We will need to review books and records, and we may need to terminate the arrangement if we identify anything that causes us major concern with the process. Again, some of ASIC's guidelines are along the lines of us terminating the process if we believe, I'll try and get the right wording here, I think it's along the lines of it would be in the interest of creditors for the company to be wound up, and the interest of creditors for the restructuring to end. Or it would not be in the interest of the creditors for a restructuring plan to enter into. These are some of the things that we're going to have to consider in making the declaration to creditors. Then we move on, and it's our role to terminate if the proposal fails, or, as I've said, it's not in the interests of creditors. A lot of the other usual types of situations arise in relation to a voluntary administration, as they do during the restructuring process, similar to the circumstances relating to creditors proceeding with applications and the like. There are some finer points around that that will be ironed out through the courts, and I understand that there has actually been one or two cases through the courts so far dealing with creditors and whether they can take certain steps and how a practitioner should adjudicate on those claims. One of the interesting points to note is that once there has been an appointment occur, we can't actually be replaced by creditors during that process. So some of you may or may not be aware, during a normal liquidation or administration, there is an opportunity for creditors to replace the current appointee. That is not the case during the initial part of the small business restructuring process. All right, so let's move on. What is the role of the director? So the director is effectively the key individual, directors, he or she, are the key individuals now that are central to this process. Effectively, the process, being a debtor in possession model, takes the onus away from the restructuring practitioner or the registered liquidator and slides that burden back onto the director. So first of all, the director appoints the practitioner. It's similar to the voluntary administration process where the board is still required to resolve that the company is insolvent or likely to become insolvent at some future time. And then they need to resolve that a restructuring practitioner should be appointed to the company. Once that has occurred, then the director still stays in the position of control though. And that's one of the key differences. They are able to make and conduct that business, remain in control in the ordinary course of business. And that's a key terminology for everyone to remember. A key term is ordinary course of business. It's clearly defined in the Act and in the information that's provided by ASIC as to what a director can and therefore can't do when they're conducting the business that's subject to the small business restructuring process. So in clarifying that, what's the ordinary course of business and what's not, there are some key criteria, but some of the items that ASIC do identify are not selling the business. Obviously, to sell the business is not conducting it in the ordinary course of business. Another one of those items that they've highlighted that they don't believe is ordinary course is to pay dividends from the company. There are a whole lot of other items that you could obviously look at that wouldn't be in the ordinary course, but that gives you an idea. Now, it's not that those things can't occur during the process. It's just that the director would otherwise require approval from either the restructuring practitioner or the court for those types of things to occur during the process when the appointment has occurred and the restructuring process is underway. So some of the other requirements, the role of the director during the process is for the director to give the practitioner information about the company. We need to have the information from the director in relation to the company's affairs and dealings so that we can assist with preparation of the plan and adequately prepare the statement to go to creditors. The director needs to allow the small business restructuring practitioner to inspect the company's books and records. There's required to be transparency there. Now, again, this has been an interesting point of discussion as to, A, are we required to conduct investigations like we would as a voluntary administrator? And if so, what level? And if that level, what do we do about those investigations? Now, there is no detailed reporting requirements under these provisions. We're required to inspect the books and records, and then the way that that ties in is back to those comments that I made earlier around terminating the restructuring. The practitioner's requirements to terminate the restructuring if it's not in the best interest of creditors, if it's in the interest of creditors for the company to be wound up. So whilst there's not this positive obligation for us to be reporting detailed investigations to creditors along with proposing the plan, there is an obligation on us to be looking and understanding if it was in the interest for the creditors to actually wind the company up. So I think we'll find more development and more clarity coming around those points as we get further into conducting these types of appointments, further understanding from the regulators and from the courts in relation to how they may play out. Lastly, the director needs to prepare the plan. Now, there is approved forms as to how these things should be documented. ASIC have put together some approved forms there in relation to both preparation of the plan and then the proposal statement. And then if that plan is accepted by creditors in their voting, then it will be on the director to actually execute that plan and bring it to fruition. All right, so let's move forward into the areas of eligibility criteria. And this is probably the key points that we're here to discuss today. We're looking at going through step by step what items are required from a client in order to qualify with the process and what points may exclude them from participating into that process. Now, one of the things that I'm talking to clients about regularly at the moment, even as of yesterday, having a conversation around this type of an appointment, is the timing of the appointment and what consideration needs to be done before we look at entering into an appointment. So it is appropriate in these situations, if you are considering with clients, even engaging with a firm like ours, to assist you to prepare the client in order to be ready, in order to appoint, to conduct this type of process. I know it's a bit of a mouthful of a statement, but the process itself, as we'll consider the next slide, is a 20 business day period. So that period, whilst it is a fixed period, there is a small window of adjournment available that is available under the provisions, but nothing significant. Now, as we get through some of the other criteria, it will make a lot more sense as to why I'm saying this, but it is one that I am urging a lot of my clients to clearly consider, to go through checklists, to work out what needs to be done during that period and actually considering it beforehand in order to make sure that things are, the ducks are in a row, if I'm going to use a cliched old statement. It's not something that you want to get into the 20-day business period and then find out you only have a very limited time to bring some of these up to date or in order, which could be terminal to the client being able to access these types of provisions. Okay, so let's get into the criteria. This is probably the key area of discussion in relation to whether clients can't, do they qualify for the process. So, first of all, criteria, there's two different criteria here. Criteria 1, 2, and 3, I believe, criteria that have to be considered and the client needs to qualify for before they enter into the actual restructuring process. The second two criteria are required to be in order before the end of the 20 business days. So let me recap on that just to make sure we're all very clear. We have a piece here that is a restructuring process that is 20 days that provides the director time with the practitioner to formulate the plan and the proposal to be put to creditors. Once that has been put to creditors and creditors accept that proposal, then the plan is undertaken and the actual restructuring process occurs. So there's some key points there. One is when the actual beginning piece of the restructuring process starts, and the end of the 20 days when the director and the practitioner put forward the proposal to creditors. They're two key points we need to remember. So the first criteria is that liabilities are under $1 million, excluding employee entitlements. So before the client can even consider entering into the beginning part of the proposal, they need to consider this criteria. Now, this is an area that has probably caused the most interest and had probably the most scrutiny in relation to sitting down with clients. I've found myself, it's very easy to look at a client's balance sheet and say, you do or you don't have a certain amount of liabilities. Many times we look at a situation, the matter I was looking at yesterday with a client where they have about $500,000 worth of related party creditors that the directors and the related parties don't see as being liabilities or current liabilities and don't consider as part of the actual creditor pool. But when you add them to the $750,000 worth of other creditors, be it ATO, trade creditors, bank liabilities, it does push them over this limit. Now, there's been discussion between various practitioners and clients around the concept of whether debt forgiveness can come into play and those types of ability to get back under the debt threshold. And that's something that may be worth considering depending on how your client sits with that sort of thing. One of the other things that we've considered is things like contingent creditor claims. Now, this criteria needs to be qualified during the process as well. So what you want to consider before you look at an appointment is, are there any other extenuating circumstances that could lead to a situation whereby the liabilities actually are over $1 million that we didn't realise. It would be not favourable, obviously, with a client if they went into this type of an appointment, got half the way along and found out that there's $700,000 worth of liabilities that they believed actually turned into 1.1 because of a claim that they hadn't considered. So again, this criteria is probably an area where a little bit of work needs to be done in relation to considering all the liabilities the company may have. There's some questions over there, obviously, in the slide that are relevant. Has the company fully considered the extent of liabilities, like I was saying? Have they factored in any loans for related parties? Again, that discussion. Have they considered the impact of third-party financing facilities? Common conversation is, yes, I've got $250,000 worth of ATO debt, $250,000 worth of trade creditors, $500,000 worth of related parties, but that's all. And we'll look down a balance sheet and say, well, what are these lease and hire purchase liabilities for this $500,000 worth of equipment that you have? That can be forgotten by a client in relation to liabilities that they may have in the company, but need to be factored into this type of consideration as to whether clients qualify for this type of provision. This is an area too that we could talk about for quite a bit more time, and I don't want to dwell too much on it because I do have other criteria to touch on. It's also probably the most contentious criteria at the moment for a number of reasons. One or two cases have been tested in court in relation to adjudication of claims and the value of creditors' claims. Also, the I suppose rumour mill that some of us are hearing is that there may be consideration for an increase in this threshold. So it's really a watch this space in that regard. The second two criteria are...
We've got some questions here. Are related party employee entitlements included, i.e. wages and super payable to director and spouse? Do they need to be paid?
Do they need to be paid? That's a really good question as to how we would treat those. It's not something that we've seen tested as yet. So the Act actually says that, I believe this is correct, I was looking at it again last night just to make sure, the usual provisions in relation to priorities in relation to an admissible creditor, it does not include employee entitlements or debts or claims that would be admissible under section 553. The question then would come as to how the test of a related party type creditor would occur. So that's one that I'd suggest if you have that circumstance and the client wants to consider going forward, it's a case of sit down, work through the numbers with your practitioner to work out how that might fall in relation to qualification, and then, if need be, whether the client's going to consider or wants to consider whether there needs to be any debt forgiveness or like done in that respect as well. So, Kent, were there any other questions?
Yeah, there was another one. I'm interested in the thoughts of the presenters on the value of the threshold for these appointments at $1 million. In your experience, is it too high or too low, taking into account the interests of the business and of the creditors?
Okay. My comments are more around that, coming back to that thought around qualifying and then not qualifying. That's been one of the concerns. I think I probably, if I look at scenarios myself that I've discussed with clients, there's probably 6 or 7 of these that we've worked our way through. Some have gone away, none of those have proceeded, mind you. Half of them have probably at least fallen short of criteria number 1. So the criteria are in relation to the threshold, where they've either been over the threshold, 1.3 or something to that effect, or they have been reasonably close to the threshold, and there was some major concerns that if other claims come forward, they wouldn't have qualified. You could argue that that would make sense, that the threshold would be increased, and that would counter some of those problems.
Graeme, could I throw maybe a different way to address that? At $1 million, I've seen some figures that it would encapsulate, say, somewhere between 5 and 10% of small business. Whereas, of course, the small business regime was brought in to apply to as much small business as it could. I think if that threshold were increased, say to $4 to $5 million, it then encompasses something like 75 to 80% of small business. So if this is to be a regime that genuine small business can take advantage of, there would seem to be some good argument that that $1 million threshold is too low, because it is going to exclude the great majority of small business that it's supposed to apply to.
Yeah, very relevant.
There's one more question here. Do you need 75 majority in value and in number from creditors for the plan to be accepted?
Now, off the top of my head, I'd have to come back to everyone on that. And Michael, do you know what the percentages are? Honestly,
yeah, majority. I think it's majority in value that vote for the proposal.
I think that's right.
As opposed to a normal resolution, say in a voluntary administration, which is a majority in number and value, I understand it's just a majority in value that actually vote.
Yeah. Okay.
Yep.
All right. So apologies for not having that at hand. Actually, to be honest, when I was preparing the presentation, I looked at the qualifying criteria and I hadn't brushed up on the actual voting detail. All right. So some of the other criteria, and these two are fairly simple and straightforward. They either are or they aren't. The company has not been subject to a simplified liquidation or simplified business restructuring process in the previous 7 years. This includes commencing the process and it being unsuccessful. And then the second one is that the directors have not been involved in a simplified liquidation or simplified business restructure in the previous 7 years. And it does include former directors of the company who have held the position in 12 months prior to starting the small business restructuring process. So these are criteria that realistically we need as advisors to consider in the back of our minds in relation to clients that might come to us in 3 or 6 or 12 months time to ask those questions. At the moment, you can see that because there hasn't been very many of these appointments taken in the 3 to 4 months we've had since the provisions, the legislation's passed and come into effect, there's not really the impact of these criteria causing anyone any great difficulty. But it is just a flag to say criteria 2, criteria 3 is something that we need to keep in the back of our mind and consider by way of checklists and resulting searches and questions for the clients before we consider whether they qualify for those types of provisions. All right, now let's talk about criteria 4 and criteria 5. Now, these are the second touch point, the second point along that line that I explained earlier, whereby these need to have occurred and be able to be ticked off before the restructuring plan is actually sent to creditors. So we need to look at our tax obligations being up to date, or the client's tax obligations. It's not required at the commencement, as I said, but it is required at the end of the 20-day process. When we say tax obligations, this is the requirement to have lodgements up to date. This is not the requirement to have actually paid the ATO liabilities, the tax obligations. Now, one of the things that I'm discussing with clients, and why we've been saying, like we were earlier on in the piece, that you really should be looking at getting your ducks in a row before you start this process is, I pose this question in response to, especially when I'm dealing with some of the tax accountants and the like out there. If your client comes to you, and hopefully it would come to you at the beginning of the 20 days and say, I need you to get all my lodgements up to date, how would that work with your workflow in order to achieve that target? Now, most are saying to me, look, I could do it, but honestly, I'd have to change things around. I really wouldn't like to be in a position where I'm put under that sort of pressure to get the lodgements up to date. So what we're talking to people about is this is an area that really needs to be considered before we look at any sort of entering into any sort of proposal. Makes the proposal and the process a lot more simple if this has been considered and at least is well and truly underway. Second item is criteria 5, employee entitlements are up to date. So effectively, this is any outstanding employee entitlements that are due and payable must be paid prior to a plan being proposed. The clients need to calculate what and if they owe their employees and make sure that they have the funds available. Again, another key criteria that we prefer to have everyone consider before you enter into the proposal. This will exclude employee entitlements that are not currently due to be paid though. So we're not in a situation where we're having to pay out all the entitlements, but it's just those that are due and payable. Again, there's a comment there around superannuation. If superannuation is in arrears, meeting this criterion may also require a super guarantee charge statement to be completed and payment made to the ATR in that respect. So I'm sure you can all see from these criteria, and I know I'm harping on this, but there could be, in relation to some clients, some work required to be done, which you wouldn't want to have to try and complete in a 20-day turnaround period.
Graeme, just a quick question that's come through just in relation to the 20-day period, just clarification there that it's 20 business days, which would obviously exclude public holidays.
Yes.
Yep.
Yes.
And the other quick question to come through, and just to clarify the availability of the small business restructuring process, this isn't a process that's only available during the COVID period. There's a comment here that ASIC is indicating that this period ends on the 31st of March. But of course, that's not the case. This is an ongoing solution available for clients.
Correct. Where the indication from ASIC has come in relation to 31st of March, and this is fairly easy to explain, it is a comment that they have on the first page of their website pages relating to this restructuring stuff. There were provisions around companies, clients, creditors, directors that were able to extend the moratorium for insolvent trading by way of making an election to enter into one of these processes. Now, that was a 3-month election that needed to happen before the 31st of March. And that's where that's where that situation has come in as to where probably a little bit of confusion and the like. So okay, were there any other questions in relation to any of those criteria? I'm also.
I had my microphone on mute as I started to answer. Yeah, there was just one other one that came in, Graeme, in relation to accountants getting paid when their clients are coming to them in order to get their work up to date to meet the eligibility criteria. And I suspect then a fear that those payments might get clawed back for one reason or another.
Okay. Sorry.
Well, I suppose I could assist with that. If the client is coming to the accountant to get their returns up to date, and the accountant's getting paid for that work, and the company then goes into a small business restructuring proposal which is accepted by creditors, the company's not wound up. So there can't be any suggestion, for example, that the accountant has received a preferential payment. But even if the company is wound up, then the argument is that the accountant has only done current work for the client. Even a liquidator can't recover that. So yes, I can't see there being any risk to the accountant for bringing the work of the client up to date. No,
I think exactly right there. The only risk that might occur is if hypothetically there was $10,000 worth of work done 6 months ago that had been billed but was unpaid, and that the client had then gone and paid for an additional $10,000 worth of work but paid $20,000.
Correct. Again, only if the company is then wound up.
Correct. Yeah, exactly right. Exactly right. All right. Now, the last point on the agenda, and I'm conscious that I've got we've got about what 15 minutes all up, and that's with some bits and pieces, and handing back to Kent to close and wrap up, is impact on the insolvency landscape, some predictions and opinions. Well, what have we seen, gents? I mean, we've seen a situation where the insolvency landscape has been very heavily affected, I think in the last 12 months by COVID, by the resulting stimulus, by the recovery activity that was available to various creditors, both in general in the economy, and the largest creditor in the country being the ATO. There were provisions around that meant that we weren't able to have winding up applications. All this has meant that we've had substantially reduced insolvency appointments over that period. Everyone would like to know what the crystal ball says about where these things are headed. And honestly, I think so would we at this stage. I think in discussions with Michael and Kent before we started today's webinar, we were talking about the fact that we were seeing an increase in inquiry, an increase in discussions happening between advisors and clients in relation to insolvency appointments. We're not seeing great pressure by the ATO at this stage in relation to them collecting their debts and pushing clients into situations where they have to address their current circumstances. I know personally the meetings and the scenarios that I am looking at with advisors, the debts are larger, very clearly larger than what they were 12, 18 months ago. If we look at the ATO's situation, common ATO debt might be between $100,000 and $150,000 we'd be looking at. Now that conversation somewhere between the 250 in relation to a similar size entity. So There is increased liability out there. There's increased debt burden out there with quite a lot of clients. Does that mean that we will see more of these small business restructuring processes? I couldn't give you the exact figure at this stage on how many of those have actually been undertaken, but I think if I was to guess, I'd say under 10 nationally so far, and that's not 10 in Warrells, that's 10 in the country. I think the number's probably more somewhere 6 to 8, to be honest. So there hasn't been the large uptake that I think the government and Treasury would have liked in relation to these types of processes. And time will only tell as to how the marketplace reacts to that. I can see another question is popping up there. Michael or Kent, are you able to have a look at that for me?
Yep. So the question is, the accountant may be unwilling to perform the work to bring lodgements up to date if the company is already struggling to beat payments. What happens then?
Well, to be frank, it's probably a matter for the director. They would need to obviously either convince the old accountant to bring those things up to date, or they would seek for somebody else to bring those lodgements up to date. Now, that's if they want to still qualify for this small business restructuring process. The other old suite of insolvency services that we've always been able to provide by way of voluntary administration and ordinary liquidation are still available, and there's not the requirement for all these things to be brought up to date if that is what the client needs in order to achieve an outcome. That's, to be honest, that's what I'm finding, Kent, in relation to most of my conversations, that there's the matter I was looking at yesterday have ruled out small business restructuring and are looking at the appointment of a voluntary administrator for various reasons. One of those is bringing the lodgements fully up to date and dealing with those other criteria.
Yep. We have another question here. How are directors' loans as a debtor treated in the process, especially if it's a Div 7A loan?
Well, this is one of the pieces around us not having to investigate the like. There is a requirement to talk about company property that's dealt with under the plan. So if part of the plan was for the director to repay said loan, and that loan, the money from that loan would provide a return, then there is a disclosure requirement in relation to the approved form for the restructuring plan. That plan talks about mandatory information that we're required to provide to creditors. It really, though, only talks about company property that we're required to deal with. Is that, if that answers that question? Michael, did that?
Yeah, no, that's good.
There's not a situation here. If I put that in context, you would have some of you would have seen the reports that we issue as a voluntary administrator, where we go forward and we consider the comparison between the deed of company arrangement and the return to creditors under that versus return to creditors under a liquidation. In these types of proposals, that is not the case. It is simply a case of us putting to creditors, here's where the money is coming from a high level, here's where the money is coming from, and here's what you'll get by way of a return, cents in the dollar. There's not a detailed comparison between what the company's financial position is and what they would get under a liquidation.
There's a few more questions coming through. There's one here. Can you provide some indication of the cost differential between a small business restructuring plan and a general insolvency process?
Okay. The best thing I can say in the initial part is it's a case-by-case basis. I know that's not going to answer everyone's question directly. One of the ways to think about this is that in relation to, say, a voluntary administration, where we are responsible for the control of the business, we are responsible for the debts that are incurred. There's substantial work that needs to be conducted in that respect. Whereas in these processes, there's a lot less involved in that side of things. The process around fees is that for the actual plan, for that 20-day period, it needs to be an agreed fixed fee with the directors that's resolved at the initial directors meeting that appoints the practitioner. I think government were initially talking about it being, they were hoping that this would be a $5,000 process. It really comes down to how good the records are. It comes down to the access that we're able to get to those records. And it comes down to how detailed the plan is and then what work has done before. If I was to throw some numbers out there, and Michael, you might have some other thoughts in this respect as well, but I was looking at the ones that I've looked at are somewhere in the $10,000 to $20,000 mark.
Yeah, I think that's right. I don't know that there's a lot of difference in the cost structure of a VA once you take out the trading aspect. And we all know trading on a business is enormously expensive. It's a day-to-day involvement, a day-to-day cost. You know, when we're the ones taking on the personal liability for a cost, we don't buy a pencil unless we know that it's in a cash flow and the company's got working capital. So yeah, I tend to agree with those figures, Graeme. I think there's still some uncertainty about the level of investigation, and certainly the level of reporting isn't there. So yeah, I would have simpler ones. Yeah, going to be around that $15,000 to $20,000.
Yeah, and there's a fair saving around the reporting requirements as well.
I have another question here. Is there a difference from state to state as far as liquidation and restructuring plans since COVID? Are some states doing better than others?
So in relation to these actual plans, I don't think that there's much difference between the states. I know the legislation applies the same across it. When you're talking about the different actual landscape itself in relation to the insolvency appointments, I think there has been some differences. I know the sort of Queensland marketplace, Michael, is probably safe to say it's been more depressed than, say, the Victorian or the New South Wales side of things. I think Perth has been, WA's been fairly robust still. I wouldn't say, it's been closer to normal than the states over our side of the country.
Yeah, certainly our regional sort of tourism industry has been affected quite badly. You can't book a room on the Sunshine Coast or the Gold Coast to save your life, but that's because it's within driving distance. But certainly the more regional areas when it comes to hospitality and tourism have certainly been significantly affected.
Got another question here. Has the moratorium in relation to serving statutory demands on companies ended? Can you serve a stat demand on a company that, although may be eligible for the SBRP, but has not engaged in the process or made any attempts to commence the process? What are the rules on stat demands generally at the moment?
Business as usual. So the moratorium has ended, and you're in a situation where you can proceed with those types of actions. It would only be if a client had, if a company director had elected to and entered into the small business restructuring process, that they would have some sort of relief. But in an ordinary course, it's back to pre-COVID. All right. I'm conscious we've got 5 minutes left. Are there any further questions? Otherwise, I'll just wrap up these slides and hand back to you.
No, I think we'll wrap up. I think we're running a bit over time.
So just to finalise from my side of things, I think you all probably know a lot of this stuff, having registered to our webinars, and I'm sure most of you have been to this type of thing before. Obviously, Worrells is specialist insolvency accountants. This is all we do and what we do. We're happy to advise on all the alternatives available so that the client gets the best outcome and can make the informed decisions that they need to. It doesn't necessarily mean it needs to be the end of the entity's financial life, and this is purely one of the reasons why we're talking about these restructuring processes. And most of you, I'm sure, would know, you contact your Worrells partner. They're always happy to give the obligation-free complimentary advice that your clients will need, as I said, to make that informed decision about the best options available. And then finally, our Worrells community. So one of the things that is always handy, I find, with dealing with a bunch of my clients is I get a lot of requests for introductions to other people. So just if there are things that you need us to help you connect with, we're always happy to make introductions between the people that we know in order to see if we can assist making those connections. So Ken, I'm finished on my side of things. I'll hand back to you, and thank you all for your time today. So I'll hand over to you, Ken.
Thanks for that, Graeme. It's certainly a very interesting and complex area, and it's difficult to fit it all into a 1 hour session, but you've been able to provide a very clear and concise explanation, so thank you. Now, we did have a few unanswered questions. So just to let people know that for any of those questions that haven't been answered, our local Worrells partner will contact you separately to answer those questions after the seminar. If you do have any further questions after the seminar about this information session or any other insolvency topic or client-related issues, feel free to email us at marketing@worrells.net.au or contact your local Worrells partner. We'd be happy to have a chat with you. Thank you to everyone for joining us. The next webinar will be a review of the announcements in the federal budget in a few weeks' time. So keep an eye out for your invitation to register. We hope to see you all there. Thank you again for joining us, and goodbye from the team at Worrells. Thank you.
Thank you. See you guys.